Thursday, May 31st, 2018, Monaco 64, home of alternative economics and contrarian views. So it's a little later than usual, 8:30 a.m. I'm going to look at the markets. And I want to talk about a very interesting subject that has been widely covered by an economics professor called Antal Fekete. And that's the theory that unemployment is so high as it is now because of falling interest rates. You might think that's a strange concept, but I'll get to that subject in a minute. I'll look at one of his papers. I'll leave some links below to his website and a link below to this article where he talks about that. And it's something that very few people bring up. He is a proponent of a gold standard, Antal Fekete. Yeah, I thought that would be interesting to talk about, especially with what's going on in Italy. A lot of people in Italy say the economy isn't doing well and you have unemployment, and it's not because of the euro. It's because the economy isn't growing fast enough. And then you look at some charts of interest rates in Italy and you look at what Professor Fekete talks about, and you kind of wonder. It's spelled F-E-K-E-T. I think he is from, I think he's Hungarian if I'm not mistaken, but he's Canadian-Hungarian, Professor Fekete. So, the markets. I won't go over what happened yesterday because I was talking about it yesterday in the live stream late yesterday. This morning though, spot gold is up about $4, 1305.60. The high has been 1306.59, and the low has been just below 1300, 1299.50. That 1302 level is still the key level. It used to be support a few weeks ago when we broke down towards 1280. We need to stay above that level, 1302. And I guess resistance right now is just around 1306.07. That has been the recent high. Silver is up 7 at 1657. The range has been 1647 to 1659. So precious metals doing unusually well for this time of the day. The Dow regained most of its losses from Tuesday, yesterday. Today, it's basically unchanged, down only 5 points at 24,663. S&P 500, 2724, up 1 point. NASDAQ 100 future, 69.91, up 15 or a quarter of a percent. The currencies, the European currencies are continuing to rebound a little bit against the dollar as the crisis in Italy has gone, for now it's kind of settled down, but there's still a lot of uncertainty there. The pound is up 42 pips or a third of a percent at 133.27. The euro is 117.01, also up a third of a percent. And the dollar's down 0.2 of a percent against the yen at 108.68. Crude oil is 67.95, just below. It's down a third of a percent. It has rebounded from the lows a little bit. Interest rates. Well, let's look at the Italian interest rates quickly here. It's continuing to drop. It's at 280 now. It's down 12 basis points from the close yesterday. The German one is up 1 at 0.39. So yeah, that spread now is below 250, which is kind of an important technical level. They're still working out, the political situation in Italy. It's still, from what I read, is that they're trying to maybe form a new populist government and keep the guy that they wanted for economic minister in the government, but not as economic minister. It's just a mess. We're still not sure if that's going to work out. We need to wait. As Goldman Sachs said in their article, Italy is not out of the woods yet. And now going back to Professor Fekete and his theory that falling interest rates really hurt labor, or creates unemployment. In the system we've got of fiat money, which is not really free market, the central banks can disrupt things, and that's what Professor Fekete talks about. Maybe people that belong to labor unions should read about this. And the reason I looked into this, I read about that Professor Fekete's theory a few years ago. And there's an article in the Italian papers here talking about why it's not the euro that's creating problems for Italy. And then I saw a chart that was the guy who wrote the article brought up, put up in the article, showing the spread between BTP and Bund, which is the gray line. But the important thing for me here is not that spread, is the yield on the BTP since 1980, what it has done. And pretty much like the US 10-year yield, we had a spike in the early 80s. The BTP looks like it went up above 20%. The 10-year treasuries went up to around almost 16%. But look how it's really dropped sharply over time. You had a period in the mid-90s till when the euro was formed. It dropped, from above 10%, around 13%, all the way down to below 5% very quickly, right? And then it stabilized and it didn't move much. It was pretty much hovering 5% before the crisis, and then it spiked higher. And then when the ECB came in and started intervening in 2012, it dropped sharply from around 7 to like where we are right now, maybe even a little lower towards 2%. So sharp drop in interest rates. So keep that in mind. Now to Professor Fekete. His website says, Professor Fekete is a renowned mathematician and monetary scientist. This site will illuminate some of his important ideas in the areas of fiscal monetary reform, gold standard university, real bills doctrine, basis, discount versus interest, gold and interest. So, and I'll read from his essay, this article. It says, the counterproductive monetary policy of the Fed, slowing inflation, reaping deflation. And the thing he talks about that's really interesting here, he goes on to say when the Federal Reserve was created, it was not, the Federal Reserve banks were not supposed to monetize government debt. They were supposed to only work in commercial paper. But they acted in bad faith and they started conspiring with the Treasury during 1914, and that was illegal. And apparently, and he talks about how in 1935, President FDR passed a law that made it retroactively legal, okay, for the Fed to do this. So you could read the whole article, but I'm gonna just focus on the falling interest rate part, which is really, really counter. Some people might think it's silly. You tell someone on CNBC or Bloomberg or a mainstream economist, you tell them falling interest rates are a destroyer not only of capital, but it creates unemployment. So he goes on to say falling interest rates as a destroyer of capital. He says open market operations, and by that he means, the central banks are buying government debt with fiat money. Open market operations for a regime of falling interest rates. My thesis, and I'm quoting on this, my thesis that falling interest rates, as distinct from low but stable, right, destroy capital across the board is admittedly controversial. I would welcome its examination without fear and favor by a competent and unbiased panel that could also examine the superiority of self-liquidating credit. Well, that self-liquidating credit is in the free market where you have bills, bills of credit, where credit is liquidated once the merchandise is taken, delivered, and it's also liquidated by gold, gold or silver, over self-liquidating credit over credit based on government debt. That could be called tongue-in-cheek self-perpetuating debt. We shall look at 3 destructive effects of a rate cut. A, the increase of the liquidation value of debt. B, labor's deteriorating terms of trade. And that's what he means by unemployment, or, being someone's labor not being worth as much. C, the fading of depreciation quotas. I'll focus more on the labor term, but also on the value of the debt. And he says the proposition that the bond price varies inversely with the rate of interest is uncontroversial and universally accepted, of course, by friends and foe alike. It describes the effect from the point of view of the creditor. Curiously, people find it hard to comprehend the equivalent proposition describing the very same effect from the point of view of the debtor, namely that liquidation value of debt also varies inversely with the rate of interest. So that's what he's trying to explain. In particular, a rate cut increases the cost of liquidating debt before maturity. Liquidation value is what the debtor must pay if he wants to retire his debt ahead of schedule. As this liquidation value is now higher, falling interest rates make the burden of debt increase. For example, if the rate of interest is cut in half, according to the rule of thumb of the liquidation value of long-term debt is doubled. That is, to liquidate the debt will cost twice as much as it did before the cut. So aside from not helping labor, it destroys capital for debtors, right? So he goes on to say, to recapitulate, both the bond price and the burden of debt vary inversely with the rate of interest. Why is it that a fall in the rate of interest increases the market price of a bond? Well, nobody will sell an old bond at face value. After interest rates have been cut, the owner will demand and the investor will pay a higher price. The reason for this is simple. New bonds that are now being issued produce a lower yield, right? So now I'm going to look into what he calls quantitative squeezing, right? And he goes on to say, the process undermining the value of money as it is trying to buy a cash flow is not well understood. It reflects the failure of the public education system. This failure is not an accident. The powers that be, under the regime of irredeemable currency, have a vested interest that the public be condemned to total ignorance on this matter. If the public realized what was going on, there would be blood in the streets. Take a typical wage earner selling his own labor, namely exchange it for a cash flow. And he puts in brackets that he needs to keep body and soul together. The cash flow represented by his wages is grievously undermined by the policy of quantitative easing. One's ability to do profitable work is quasi-wealth. It may well be the only asset the laborer has. The value of this quasi-wealth is rendered inferior every time the rate of interest is cut. For example, if it is cut in half, this quasi-wealth of the laborer is halved as well. It may sound a little bit difficult to understand, very theoretical, but listen me out and also read this article later on. He says, we may visualize the laborer as running on a treadmill, the speed of which has just been boosted, say by 100%. Now he has to run twice as fast just to stay abreast. If he wants to retain the value of his labor, he must work that much harder. And he's not a communist, but he quotes Karl Marx. He says, Karl Marx called it exploitation. There is no more insidious exploitation of human labor than giving the central bank unlimited power to manipulate the rate of interest downwards through open market purchases of government bonds. That's not what Karl Marx said, what Karl Marx said is the exploitation of labor. But Karl Marx in the Communist Manifesto, he called for decentralization of money through a central bank. So he was confused as well. Mockingly called quantitative easing. It had better be called quantitative squeezing of labor. So there you go. I think that's why the Western world and the Western economies are in a quagmire. That's why we have high unemployment. It's because the central banks can artificially intervene in the markets and artificially keep interest rates low, cut them in half willy-nilly. The other thing it does that he's talked about in some other articles is when interest rates keep lowering, the cost of capital becomes cheaper, and companies would rather invest in technology in order to automate their operations than invest in labor. That's another reason why we've seen the problem of unemployment, youth unemployment in Italy. So that's my idea for the day. I really recommend you read this article. It's 16 pages. I've taken the parts that I thought was interesting. So there you go, quantitative squeezing. And that's why people are not happy about things. That's why you get what you get in Italy. But very few people kind of realize what the real problem is. They think that interest rates need to be kept low and low. But I'm not saying they have to spike higher, but maybe they will. What Professor Fekete says, it has to be redeemable debt, and it needs to stay stable and relatively low. And that's what creates wealth and free market capitalism. So there you go. If you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on Steemit, DTube, and on Twitter. And I'll talk to you later. Bye.